All right, a very, very happy morning to everyone. TGIM. I hope everyone had an excellent weekend, and some of you may also have had an extended weekend with the Thanksgiving that we just had last week. So a little bit of a late start because we had a few technical issues with people getting on. It's also worth noting that it is going to be a much shorter, concise Macro Monday than usual, just due to kind of combination of Thanksgiving hauls, getting towards the end of the year, and people needing to take well-deserved and earned holiday slots. I will not be joined by my wingman today, so there'll be no COT report and there'll be no technical analysis. But that's okay because we've had quite a few recent ones that have been quite long in essence. Main thing I'll be again refocusing on again is stuff that we touched on last week, and of course the call on euro dollar. Destination parity. We'll be examining some of the risks towards that, and I'll be highlighting what else I think is key for the week up ahead. So as usual, please do enjoy. And of course, if we go through anything too quickly, make sure you get the replay later from your relationship manager or sales trader over here at Saxo. Goes without saying, everything we do cover here is solely views, opinions. None of this is trading nor investment recommendations. Everyone should do their own DD and deep dive and work. For trading investing quotes for the week, we got one from Jack Schrager, who, as you all know, has written kind of the market wizards. Ed Sayakota is actually one of probably the old school systematic traders out there, quite well renowned. Also, Schrager actually interviews him in one of his books. Let you guys decipher the words there. And in regards to kind of last week, week 47. Again, given the Thanksgiving weekend in the U.S. As well as Japan being closed last Wednesday, wasn't really a typical kind of full trading week because obviously a lot of volume started to not only peter away already from the beginning of the week, but definitely towards kind of the end of the week. I think the interesting thing there is, we only now have 5 weeks left in the year. There's actually only going to be 2 more Macro Mondays after this, and there's only I think 3 main at least known unknowns on the calendar to look for potential kind of opportunities. One is the December 4th Italian referendum, December 8th ECB, and December 14th Fed. And there's risks and opportunities across all kind of three. For the week 47 summary, I kind of had the VIX chart that we used last week. We actually lower than this. We closed at 1234. And what I was trying to allude to is kind of where we are around this November levels compared to where we were a year back, right? And you can kind of see the big moves that we had, obviously going into, this dotted line over here is the DEC Fed hike, right? And obviously we had the sell-off at the start of the year where you could kind of see the VIX kind of popping back up. Bottom line, what we're basically trying to reiterate here, VIX is low, equity vol is low. Whether that's right or not, we'll have to wait to see for the next kind of few weeks. I think it's way too low, given a lot of kind of the moving parts, potential EM meltdown, the dollar strength that keeps on going on, and also just based on the fact that it wasn't until we actually got that first Fed hike last year that we actually proceeded to see a sell-off, right? So we could see, similar tones. And again, from my perspective, as I keep saying, for those who are looking at kind of VIX calls or using that low equity vol to purchase kind of downside, you don't need the VIX to go to 20 or 25 or something like that. As in, you don't need for your premium to double, right? You can just be looking for 20, 30% return on kind of your premium. Just some points in the sand. S&P again, ever higher highs, new all-time highs at 2213, plus 120 basis points for the week. VIX degraded down. US 10s again, new highs, got to 2.4. DXY new highs, we closed at 101.49, 30 basis points up for the week. Gold continued to degrade, another big week down. And at these 1181, yes, it does look oversold on both the daily and the weekly, and actually as we're speaking now, it's popping up a lot, about 85 basis points at 1190. But you'd have to wait and think, given the technicals, maybe people will start looking at that 1150 line, and of course WTI just pretty much flat for the week. So the continued move up in U.S. equities has me and I think a lot of people kind of scratching their heads. I think the only possible rationale around this stems from maybe capital living, fixed income, and emerging markets, and kind of going into that. It's something we'll touch on a little bit more kind of later on. This is just a few charts. This was euro. We made that new low, 105.18. So we took out the other 105, I believe it was 24 or something like that. And now it's really all about the 104 set in March 2015. Same thing on DXY, new highs, 102.05 was set. And again, we've now had 2 consecutive weeks closing above 101. Very, very kind of constructive and bullish. Probably makes 101 a key level, but definitely I would expect a lot of very strong support at around 100. Dollar yen, definitely here going to the moon. I was talking to people a few weeks back about this being 115 when we were kind of around 106, and I was giving it 3 months. That's starting to look very, very far from aggressive. And of course, this is the S&P. Right? This here is U.S. 10-year yields. This is, of course, Thanksgiving Thursday when the bond market was closed. And you can see new near-term kind of highs of 241. And if you recall, I was thinking we'd get to at least 2.5 easily before the Fed hike. So we just don't seem to be too far from that. We now have a 100% Fed hike probability, with I think plenty of risks also to the downside in case we get a dovish hike, and it seems to be protracted or portrayed as one and done, but also to the upside, i.e. if we get a very hawkish hike, right? I think the Fed minutes last week were pretty stale. I mean, we've already seen them comment quite a bit post that, right? Again, equities were up globally, including the Eurozone that saw stuff like the Italian index up close to 170 basis points at these like 16,500, which is quite astounding. I would have thought, given that we are 1 week away into the referendum, that we would be south of 16K easy. So quite interesting to see kind of what's been going on there. We already covered the currencies and as well as some of the commodities. I think the other thing worth noting on the commodity space is this huge speculation we've been having in copper, right? Another 7.2%, just south of that 270, which I just think is just really, really very much kind of getting ahead of itself. So I'd definitely be looking for potential kind of downside plays there, either puts or something like that. And again, we saw this fixed income divergences in both the fact that U.S. yields kept going up and Eurozone yields actually came in for the week despite the upcoming kind of risk on deck for it. And I kind of think like last week was, at least in my view, probably was a quiet before the storm. So it could be really, really interesting how the next few weeks kind of unravel. This is just the world on a slide, as I like to show. I think the interesting things here again is the degradation we've had down in the VIX, kind of close to there. Obviously, the big kind of pullback in yields in the Eurozone. I can understand Germany and core because obviously what happens is you go long Germany and you short Spain and Italy and some of the other kind of peripherals. But still, even those kind of came in, which is quite astounding. And once again, the 30-year definitely is holding out better than the 10-year. I'm not quite sure how long that will go. I think at some point, the 30-year will have to actually correct and go towards that. And this, I think, was copper. You can kind of see copper 7.2% for the week, 25% for the last 1 month. And yes, I'm very, very bullish on U.S. Macro and the fiscal spend there and infrastructure, but by the time they actually get orders and stuff on the ground, that's going to be 2018. So I think this is very, very early, and there's a lot of speculation behind this. So I'd watch that very, very kind of carefully. And again, interesting to note that we have the MIB back up above 16,500, as well as DAX still at kind of these 10,700 kind of levels. So quite interesting kind of moves, I think, there. Interesting to see, Euro actually closed barely in the positive, breaking a 2-week fallback against the U.S. dollar. And some of the other stuff that performed very well last week was Aussie, obviously close to 1.4%. Charts and technicals, they're actually looking very, very strong for this kind of upcoming week, as is kind of the Kiwi, which I think even looks better. That closed back over that 200-day, key moving average. And it's also kind of lagged the performance kind of last week, and of course kind of sterling. The thing that I also spent a little bit of time was on this dollar Mexico, and you can kind of see the vol has degraded, which is one thing that we were watching out for a long time, and it also now seems to be, I think we're potentially past the point of maximum pessimism on this. Obviously, there's still a lot of question marks on, how NAFTA is going to be addressed, will it be rewritten, et cetera, and so on. But I just think it's worth spending a lot of work on dollar Mexico because I really do feel it's could be a rock and roll trade for 2017. Not to even mention just the carry that you could be picking up, and we can do NDS, we can also do spot on this, and I think there's some interesting structures to be putting up on this, and it could be one of these trades we look back in a few years and be like, wow, I can't believe we didn't take that up. This is the slide we put up last week. It's just showing kind of the Italian constitutional referendum overview, significance process. Quick rehash, third biggest economy in the Eurozone, founding member not only of the Euro, but also the European Union. And they have this constitutional referendum vote on this upcoming Sunday where the populace have been asked to vote a yes or no to allow the PM Renzi to actually make changes to the Constitution. And the reason he's brought it to this far is because he needs to basically curb Parliament's power to make the structural changes kind of needed through. So it would be hugely positive if they did get a yes vote. I think you could easily see the euro, kind of jump up 2-3 figures against, let's say, the dollar. But I think, the polls seem to suggest that it's biased towards the nose. And again, as we've seen in the recent votes over the last few months from Brexit, a lot of these things end up being less about the actual event and more of a protest vote. Yeah, more used as showing kind of dissatisfaction with how people are in their lives and kind of the dissatisfaction with the incumbents and the politicians, right? So again, could be very interesting. We've done quite a lot of work on this, including from my colleagues Tarek and Andrew. Do please check out this link up on Trading Floor /topics. We have a nice flow chart on kind of the different ways it could play out, given a yes and a no vote. And there's also trade ideas that you can click on that gives you a little bit of view on potential kind of structures you can put across it, depending on kind of your view. There is also a dedicated page on the upcoming Fed decision on December 14th, so you can also check that one out. So upcoming week, as I said, 5 weeks left in the year, but really, it's only in the next 3 weeks. I mean, you already see once deck starts coming in, people start squaring off their books, start thinking about kind of next year, reducing their risk kind of over the Christmas holidays, and that may even be more prevalent just this year, given just how heavy the whole year has been kind of overall. The key focus this week, I mean, there'll be a Castro focus, which could be maybe interesting from a pricing perspective of maybe what maybe Trump says in regards to maybe future relations with kind of Cuba, again, that being used as a read across to his other kind of foreign policy. We, of course, have the Sunday, December 4th vote. So once again, Asia will be at the forefront of, that kind of, I think, decision. We have final PMIs as well as US ISMs and US non-farm payrolls. And there's also now a lot more focus will be kind of coming back on the ECB. The thing about obviously the ECB on December 8th is it's very linked to this, right? You can think I think the non-consensus view on this is we get a yes vote. And of course, in such a scenario, one could think that the ECB does not have to be as dovish, right? Whereas if we get the opposite and we get a no vote and it's actually taken quite negatively by the market, there's always a question of how much is kind of priced in, then you can potentially expect the ECB to be a lot more kind of dovish. You could already see some risks on ECB potentially being less dovish, just given how firm it seems like we'll get a deck hike from the Fed, and also just from some chattering from ECB quote officials, right? This week is not that much from the central bank's perspective. There's some BOK minutes, the page book from the Fed, financial stability report out of Bank of England. We will have a rate decision though from the Brazilian central bank, where the market seems to be expecting a cut, right? Some first, there's a few Fed speakers up on the board, and we'll also be hearing from Draghi, Bank of Canada's Paulos, and RBNZ's Wheeler. Of course, also the OPEC meeting, which I don't really have a view on. Ole has kind of been a little bit all over this. Last I heard, and this may be a bit stale on the info, but it almost seemed like even Saudi Arabia wasn't sending people to join it. But definitely one that's going to be heavily watched kind of this week. And it's all about seeing whether the broad agreement that they agreed to last time can actually be put into practice, right? Um, and let's see what else we got here. We already talked about the PMIs. Obviously, China again will be also obviously key. Remember last month they beat very hardly. Again, the UK always with sterling and keeping that strength going. And non-farm is 175. Non-farm is probably one of the few things that could take quite a bit of the mojo out of the U.S. dollar, but you'd need an abysmal number. I think you'd need something south of 100K or something like that, and something to really make the market kind of question. Okay, maybe the Fed will not move kind of in deck or something like that. Not that I think even a number south of that would do it, but you just never know with this Fed. Regards to kind of general take, I mean, just reiterating kind of from last week, I still like this short bias in eurozone equities as well as bonds, into the end of this week, especially on the bond side, stuff where maybe you're long some of the cores, such as Germany, or maybe even let's say like the Netherlands here, right? Versus short some of the peripherals, which I have here on the left. These were the infamous or the famous pigs. So this just shows you how the yields of this is actually the spreads between let's say Italy and Germany, for instance, which here is at 184, right? So this is kind of the difference. So obviously, as the spread increases, it shows you that the market's anticipating a lot more kind of stress for that country, for the sovereigns in that country. And interestingly, here enough, actually, it's interesting to see how much Greece has actually come back in, while Italy and the likes of actually Spain have gone out. And if you just kind of go back to give you context, this is the 2011-2012 Eurozone crisis. You can actually see the spreads were much higher than currently what we're seeing, even for the other kind of cores, right? This time you had actually France out at 150, Belgium at 350. Now, I'm not trying to say that we should go back close to some of these levels, but I definitely do think that there's more upside on these spreads kind of widening, bonds being bid, and then versus Italy and Portugal and the likes of Spain, them being offered kind of there. So I've actually been speaking to a few clients about where you basically long Bund futures and you short, Spanish and for instance, Italian, as well as French, because obviously if you get a no vote in Italy, the next kind of big focus will be again on kind of France, as these domino effect kind of tend to kind of happen. I think kind of going on here, I was just trying to show that while spreads and bunds have held up better than expected, as have equities, only euro has really seen an erosion in strength, and I think that's really most likely this year is the euro, the first big move we had. This was the U.S. election, right? And when you go back, it seems like the majority of the move down has been a combination of the U.S. election and the Fed, and less, at least to me, about really what's kind of happening in Europe, i.e., with the Italian kind of referendum. If you take a longer kind of chart, you can kind of see the significance of the break that we've just basically kind of gone through, right? This is going back all the way from 2000. This, 1st of Jan 1999 was the birth of the actual euro, right? Started a kind of, I thought actually it was supposed to have started at parity. Maybe it kind of traded up there. And what a lot of people forget is for the majority of this period, you basically had a bear market in the U.S. dollar, right? And it wasn't until about 2011 that it bottomed, and 2014 that it really started to kind of take off, right? Which again is another kind of I'd say wind behind my kind of parity kind of call, right? But let's go back and look at kind of some of the risks. Let me just go back here. The moves have actually been huge. I was just speaking to clients a little bit over 2 weeks ago. We had dollar yen at 106, euro dollar 108.55, and I was already starting to talk about us being at 115 on dollar yen and euro dollar heading to new lows and then parity within 3 months. And if you do like a mark to market, we got to about 114 last week on dollar yen, making that kind of 115 handle look very conservative. And on euro dollar, as we pointed out in the chart, we broke that 105.24 low, which was from December 2015, right? With 105.18. I mean, the key level really is 105 because I think once you kind of break, then a lot of the parity drums will kind of come out of the closet, and then obviously this 104.58, which was the March 2015 low, right? So I think key risks on the parity call, and anytime you say key risks, it also means key opportunities, right? Whether tactical or strategic, is obviously a positive outcome in Italy. A yes vote, as I said, is probably plus 2-3 figures on euro dollar, and it probably also would inspire the ECB to be less dovish than maybe they had intended to, right? They can kind of keep that dry powder for next year. So maybe at most all we get is an official kind of confirmation of an extension for them. At the same time, I think it'd be a great shorting opportunity because obviously, the week after the ECB, we have the Fed, right? So any kind of euro dollar moves to 108, 109. I would argue is probably a gift from the gods towards kind of the short side, right? I thought last week would have been the best opportunity for euro to pop up, and it just didn't seem like to be able to kind of do it. But who knows? I mean, we have 40 basis points this early Monday morning Asia at 106.34, so perhaps it's early on this kind of week. Again, ECB not being dovish, combination of upcoming Fed meeting that could be that's a key risk. We've already talked about this technical kind of correction and momentum and magnitude. Technically, without even any fundamentals, a lot of things against the dollar, including the euro, could do with a bounce, could do with a pullback. And there's a little bit of a play on that. And I think, a dovish Fed to no Fed hike, small probability of this, but obviously anything's possible, would obviously be hugely negative for this parity call. You could even say it throws it back by 6, 12, potentially 18 months, right? And I think yes, I would argue short euro dollar is a consensus view. Yet from a positioning perspective, we're not even close, right? Last April 2015, I think we were short about $30 billion. Now it's we don't have the COT report, but it's kind of mid-teens at best. Right? It's more like 12 to 15 or something like that. So nowhere near as short as we have been, and you can kind of see that in the rhetoric. Right? It's not as hardcore as it was a year ago when everyone and their mom was telling you that euro dollar was going to 90 cents on the way to 80. Right? We keep getting this question. I've been speaking to about clients on this. U.S. equities keep rallying. What to do here? My view here is obviously it's quite tricksy, as I say, and I think the fear or the quote-unquote pain trade, if you will, is the melt-up continues. This is both a combination of year-to-date performance of where we are. Some of these indices are up like 10%, and you only have 5 weeks left, right? So if you're an index tracker or something, you may have no choice but just to get involved. At the same time, you saw what happened when we had the hike last year. It kind of led to the sell-off. So it's a little bit really, I think, tricky. And the only thing I can think to justify equities being up here in the U.S. is, some kind of asset allocation. I prefer to play this equity melt up through options, especially given how low volatility is, right? So whether it's at the money or at the money calls on the Nikkei, and this is just personally because I feel a lot more confident about dollar yen being at 125 to 135 by the end of 2017 than S&P 500 being at 2,500 by the end of next year. Not that I'm not saying it won't be there. I just feel a lot more confident in the currency first call, right? And I would focus really on the S&P 500 and the Russell 2000, and I'd avoid the Dow. Again, multinationals, so a stronger U.S. dollar hurts earnings there. I'd avoid the FANGs, as well as all the other kind of previous concentrated spots that we've mentioned many times on Macro Mondays. Low vol ETFs, utilities, yield-seeking ETFs. It's worth noting that they also started to crack down on some of these leveraged ETFs, like because a lot of them, even if the underlying is moving in the right direction, the investor still ends up making kind of a loss. I've just picked up here an option table just to show you. I'll just walk through the S&P and the Nikkei. This is basically, it's kind of taken 110, so 10% out the money calls, 6 months. So that's the strike. This is the cost. This is the premium you pay. So for a 6 month, 10% out the money call on the Nikkei has a 20.2 strike, and it's costing you 184 basis points, right? And that gives you about a delta of 24. Same kind of 10% out the money on the S&P 500, costs you only 35 basis points. The delta is lower though, so if you take the delta up to 25, it's costing you closer to 1.2, which is still actually the cheapest of all. And you have 180 days, and your premium on a per day that you're paying is tiny. And I think this is a very plausible way of still having skin in the game, but not having the conviction, let's say, to pick up the underlying in size, right? And you can do a lot of these in size again, given kind of how inexpensive they are. So it's also worth noting that the Nikkei is about 12%, south of the highs from last year. The highs from last year were about 2,100, right? And dollar yen was about 125 then. So I do also kind of like that catch-up factor is there as well, rather than this we have to go into new highs. We have to go into new highs. Also worth noticing, I put on the DAX there and the FTSE MIB, the Italian, just from a kind of contrarian kind of perspective. Obviously, the DAX should do quite well if we do get that euro parity with the dollar, and again, quite inexpensive, right? And I think that kind of wraps it up, really, from positioning kind of thoughts week ahead. As always, we got some great webinars and stuff for you guys to come and check out. We have upcoming commodities pitched by Ole, kind of highlighting 2016, some FX option stuff coming through. Always good stuff, and a lot of great content on the archive stuff. And please do join us next week. Same time. There's only 2 Macro Mondays left before we're back on about kind of the third week of Jan, just kind of given the end of year hauls. And any questions, do please mail us. And let me wish everyone a fantastic day, fantastic week ahead, and profitable positioning out there. Thank you very much.